And I think maybe the other issue that is within that is that gold is completely outside the dollar system, and ultimately revaluing gold a lot will move the currencies, but it's a bit of a blunt instrument. I do think the stablecoin rollout by this administration, it's really going to come down to, competition. And China and their factories and Russia and their commodities, if they decide they want gold, then they can compete for that. But ultimately, the free market between gold and Bitcoin, it is that's where it'll be decided, right? If you are Russia and China and you reserve gold and you don't reserve Bitcoin and Bitcoin wins.
Groman, founder of Forest for the Trees (FFTT), has long argued that the global monetary system is undergoing a profound transformation, one that puts gold back at the center of global finance. His analysis paints a clear picture. The era of unchallenged US dollar dominance is coming to an end, and gold is quietly re-emerging as the ultimate anchor of trust in an increasingly unstable financial world. Groman believes that years of fiscal excess, combined with runaway debt and weaponization of the dollar, have forced other nations to seek alternatives to the US-centric financial system. This gradual but decisive shift, he says, is creating the most powerful setup for gold in modern history. According to Groman, the core issue lies in the unsustainable debt structure of the United States. The US government's reliance on constant borrowing and money creation to fund deficits has fundamentally weakened the dollar's credibility as a global reserve currency. While this system worked for decades, Groman notes that the world's largest economies, particularly China, Russia, and members of the BRICS bloc, are no longer willing to accept perpetual dollar devaluation. Instead, they are accumulating gold at record levels, laying the groundwork for a parallel system of trade and finance that relies on hard assets rather than paper promises. He argues that this accumulation is not random, but a strategic maneuver to insulate their economies from Western financial sanctions and instability.
Yeah, in essence, yeah. I mean, de facto, we can see, we said gold defeated long-term treasuries as a reserve asset. And that's, call up GLD over TLT on a chart. Any trader in the world can call it up, and it is up and to the right exponentially over the last 10 years. Gold won. That's can easily be seen. The U.S. has some choices. It can go with gold. To your point before, there are probably interests in the United States that see gold as giving too much to the Chinese and the Russians. And I think maybe the other issue that is within that is that gold is completely outside the dollar system, and ultimately revaluing gold a lot will move the currencies, but it's a bit of a blunt instrument. I do think the stablecoin rollout by this administration, I think they see as, in my opinion, sort of standing up Bitcoin as a neutral reserve asset for the U.S. There's people that see attractiveness to that, and I can see it too, because ultimately the higher Bitcoin prices go, you can see a very clear relationship over time between Bitcoin and stablecoin market cap. And so, there's a question around chicken or the egg of does Bitcoin go and then stablecoins or vice versa? But in the end, if stablecoin market cap goes up a lot, Bitcoin's probably going to go up a lot. And if Bitcoin goes up a lot, stablecoin market cap's probably going to go up a lot. Now, we don't have to speculate. We have attached stablecoins to T-bills via the Genius Act. There's no mystery about that. And so I look at it as if I was sitting in this administration, I'd say, look, Bitcoin goes up a lot. Stablecoins are going to go up a lot. T-bill demand is going to go up a lot. And that gives me more fiscal flexibility than if gold goes up a lot as a neutral reserve asset. And that's really the angle I come at it from. When it really comes down to that relationship between, the stablecoin market historically and the Bitcoin market historically. And you can see this, it's one of these things where coming a year ago, even this time, maybe 14 months ago, I wouldn't have even thought of it. June or July of last year, former Congressman Paul Ryan talked about how stablecoins could be used to help finance deficits in T-bill markets. And then I participated in a discussion at the Bitcoin conference last year where somebody who knows President Trump personally, their son told a member of that panel the night before that, Dad, President Trump, says that Bitcoin is the new oil. And at first I just thought that was a nod to the energy proof of work of Bitcoin. But then later that fall, we saw the Treasury Borrowing Advisory Committee, the group of banks that advise Treasury, and this is in the Biden administration, this is not the Trump administration, discussing a quarterly report how digital assets can help support the Treasury market. And they specifically cite how stable coins and a market cap and Bitcoin and crypto market cap have gone up, and that ultimately that could, if paired with T-bills, create demand for T-bills. And so that's where I come out at, is ultimately, to me, it's Bitcoin. It's not crypto, it's Bitcoin. Bitcoin market cap goes up. There has been a pretty good relationship over the last 10 years between Bitcoin market cap and stablecoin market cap. And in the ensuing 6 to 8 months, we have now, passed the Genius Act. We have Secretary Bessent talking about how the Genius Act, could free up, $3.5 trillion worth of what was the phrase? It was a $3.5 trillion worth of stable coins from around the world. So it starts to look a lot like the petrodollar system of where, you got to have dollars to have oil. You got to have dollars to have stable coins in some way. And a lot of those dollars are going to end up in Bitcoin. Those stable coins will end up in Bitcoin market cap, is what history has shown. And so that's why I say, to me, it looks like they are quietly standing Bitcoin up to compete with gold, which has very clearly competed with and defeated treasuries as a reserve asset. Well, ultimately, you'll only have one, right? But to have two, you're going to have a new iron curtain between the two. And I think that's impossible for a number of reasons. And so it's really going to come down to, competition. And China and their factories and Russia and their commodities, if they decide they want gold, then they can compete for that. But ultimately, the free market between gold and Bitcoin, it is that's where it'll be decided, right? If you are Russia and China and you reserve gold and you don't reserve Bitcoin and Bitcoin wins, you lose.
But why couldn't there be a system where you have two reserve assets?
Just because ultimately one, without having an iron curtain that separates the two economies entirely, you'll have too much leakage, right? So one is harder than the other. One is going to be used or the other. And, basically Gresham's law, right? Like, you've got currency that is, in circulation, pre-1964 dimes are silver and they're worth, $3 a rattle. And post-1964 dimes are also in circulation and they're worth 10 cents. And you can never find basically any pre-1964 dimes because everybody knows they're worth $3, not 10 cents. And in the same way, as a reserve basis, if you've got a flowing economy where, you're ultimately going to want to reserve the best asset. And that's, I think we're sort of figuring out what that best asset arguably is. But it's very, multi-currency systems generally haven't worked. You had a gold and silver system, right, back in the late 1800s in the US, and there was constant friction around what's the ratio of gold to silver. You would have constant friction. And the governments could say, well, gold is worth this much Bitcoin or Bitcoin's worth this much gold. And at the end of the day, if you're wrong, market's going to sell the one and buy the other. Just like they do with gold and silver, just like they do with the post 1964 dime and pre 1964 dime. You'll only end up with one, whether you declare it or whether you actually do it, unless you put an iron wall and there is no more trade. China does no trade with us. The Russians do no trade with us. Oil is no longer a globally fungible market, which is, of course, in my opinion, impossible in an era of the internet.
From a macroeconomic standpoint, Groman also points to the growing divergence between nominal interest rates and real purchasing power as a critical driver of gold's rise. Inflation continues to erode the real returns on bonds and cash, leaving gold as one of the few assets capable of preserving long-term value. He often highlights that the US Federal Reserve is trapped unable to raise rates high enough to contain inflation without triggering a debt crisis, and unable to print endlessly without collapsing confidence in the dollar. In such a no-win scenario, Groman argues, gold becomes the logical escape valve, a neutral, non-sovereign asset that cannot be printed or defaulted upon. Groman further predicts that the revaluation of gold could happen much faster than most expect. As geopolitical tensions intensify and countries diversify away from the dollar, gold's role as a settlement asset could accelerate dramatically. He envisions a future where gold-backed trade agreements, digital settlement systems, and sovereign wealth diversification all converge to redefine gold's value not just as a hedge, but as the core collateral of the next financial era. In such an environment, gold prices could rise multiples from current levels, not because of speculation, but because of necessity.
Interest at heart. I think that's probably one thing. And I think maybe the bigger thing is that there's one industry where the U.S. retains a real semblance of dominance, and that's tech. And in particular, the way, maybe the last great way the United States reaches the world through this thing, right? Our iPhone and U.S. consumer tech. And so the U.S. can leverage U.S. consumer tech and tech properties around the world, tech dominance around the world, much more easily with Bitcoin than it can with gold. And I think that's probably part of the gambit as well. We'll see how it works out, but I think that's part of the gambit and logic as well. I can make cases both ways. The safest is probably gold. But for me, I would rather own both. I wouldn't limit myself to one or the other. I would own them both. If I had to choose one, not knowing anything else, the safer choice is for most people is probably gold. It probably is. But that's such a wild card, right? If you came and said, hey, in the next 50 years, America's going to have a revolution, you need to flee, it'd probably be Bitcoin. So it's. Yeah.
But I appreciate you playing along. I won't make you squirm or have to sip any more water nervously.
All the hate mail you're going to get me. Yeah, but it's a very difficult. It's baby boomer and voter class that we're not paying anymore, and we're going to cut spending. That's not going to happen. There have been discussions of alchemy and fusion and these types of things, and bringing an asteroid back, and there's some asteroids circling around, and Elon's going to bring it back because that's got 1.4 quadrillion of gold on it. Like, okay, yeah, and it costs like $20,000 a pound to bring stuff home from to bring stuff into out of space, right? So let's figure that out first, right? Because maybe there's a 1.1 quadrillion in gold on some asteroid somewhere, but it's going to cost you like 200 quadrillion to get it here, and that's not bad for my gold holdings per se. That's the whole point of owning gold, is the energy cost of producing it preserves your purchasing power. That's the whole point of Bitcoin. The energy cost of producing it preserves your purchasing power. So, the reason gold's worked for 5,000 years or whatever it is there's not a whole lot that breaks it. It just does what it does. It preserves purchasing power, particularly in times of insolvent governments, which is a time where we are now. Yeah, because ultimately we've seen, if AI does even a fraction of what its proponents and the mainstream view says it's going to do in terms of job disruption, it's fundamentally incompatible with the debt-based monetary system. What do I mean by that? You've got, the top employer in 38 out of 50 U.S. states is healthcare. Most of that's in administration. Most of those jobs are like right in the crosshairs of AI disruption. Those people all have mortgages. Those people all have car loans. They all have credit card loans. When AI starts disrupting their jobs, and it's probably already started, over the next 2, 3, 5 years, these people are going to start defaulting on their houses, on their cars, on their credit cards, just like manufacturing workers did when their jobs were offshore to China in 2001. And once that hits critical mass, the U.S. is going to face a choice, which is, the banks are in trouble again because AI has displaced so many workers. They're defaulting on their mortgages and on their car loans and consumer loans. Are we going to print the money, or are we going to let the banks go bust? And if the banks go bust, guess what the banks are holding as their reserves in case of a crisis? We know this from 1Q23. They're holding treasury bonds. They're going to dump treasury bonds as to offset their loan loss reserves caused by AI causing job disruption. Then what? Well, then interest rates are going to go up in a severe recession, something we've never seen in the United States, but which everybody in, emerging market world sees all the time. They call it a cycle. They call it a recession. But with the U.S. government with $37 trillion in debt, and true interest expense at 100% of receipts already, receipts that will be falling, you're going to have interest rates going up in a recession as your receipts fall. So the Americans are going to have to go, are we going to print the money to pay the interest and the entitlements, or are we going to default? And if we default, the debt backs everything. And so that's sort of, a version of hyperinflation. If we print the money, it's very high inflation. So your AI, paradoxically, is initially very deflationary, but ultimately in our debt-based system, as over-levered it is catastrophic in terms of the structure. And that's why I say all roads lead to gold and Bitcoin. Ultimately, they're going to have to print the money to make the banks whole, to, they're probably going to have to create some sort of universal basic income, et cetera. That's my view of it. And there's, There are more optimistic interpretations of what AI might do. And, maybe people will, get fired from their job by AI and they'll find something else to do. A lot of people will. A lot of people won't. A lot of people won't. In the real history, when you want to be honest about it, a lot of people don't, right? Remember, learn to code. Don't worry, all these manufacturing workers, they'll find something else to do. They didn't. A million of them died of drug overdoses. And then, they were given, subprime loans to paper over their consumption until the subprime market blew up and then the economy blew up. So that's why I think AI, to me, the easiest way to play AI is just own Bitcoin and gold.
In the near future, the global monetary landscape is poised for a seismic shift that will redefine how the world perceives value, and gold will be at the heart of that transformation. As debt levels reach unsustainable heights and trust in paper currencies erodes, nations and investors alike will turn increasingly toward hard assets as anchors of stability. This gradual yet unstoppable transition will not be a mere price rally, but a structural revaluation, a global recognition that gold is not just a commodity, but money itself. The current financial system, built on confidence and credit, is running on fumes, and when that confidence finally collapses, gold will be the asset that rises from the ashes to restore balance. In the years ahead, gold could enter an unprecedented supercycle. Central banks, especially in Asia, are already signaling the direction of this shift by hoarding record amounts of physical bullion. Once dismissed as relics of the past, these purchases reveal a strategic understanding that the future of finance will once again revolve around tangible, non-sovereign assets. As the dollar continues to weaken, under the weight of trillion-dollar deficits, foreign nations will accelerate efforts to trade outside the US financial system, likely backing regional currencies or trade settlements with gold. This quiet, yet powerful movement will send a clear message to the global economy is preparing for a post-dollar era. The coming years will see the collapse of confidence in unbacked currencies, the rise of gold-backed trade systems, and a historic revaluation that resets global wealth. If you see what's coming, don't stay silent, like, share, and comment your thoughts.